Morning, Randy. You are the early bird that catches the worm. First one here. Nice work. We're not fucking around, at our age. Yes, morning. How was class last night for you? Oh, and did you get a chance to watch to watch the parts that you missed? I forget what we even talked about, but we talked about something. I think it was interesting. Let's see here. Yeah, I did not. Reviewing hedges this AM. And what do you mean by that? Reviewing hedges this morning. What are you doing? That could mean so many things. So I'm not sure what you mean by that. Like checking your iron condors, looking at your hedge. Possibly you're rewatching the QQQ hedging video with the delta neutral thing for the market mastery. One of our cats is in here. He keeps rubbing my leg. Man, that's gonna get annoying, bro. Already annoying. I need more specifics on it. What hedge is best used? Call, put, CCS, PCS, the market mastery video. UQQ puts. It's not a CCS or a PCS. It's just a raw vanilla put. You have one, didn't you? Oh, maybe you got a QQQ put credit spread. You're so used to getting credit spreads that you got a credit spread. No, you should have just plain QQQ put. Just plain and simple. You don't sell it, you buy it, and you don't buy the next strikeout. It's just a plain simple QQQ put. Yeah, you should probably watch that episode again. Marcus, good morning. Hello. Okay, I was just listening to a message. Randy, you said that's what I thought after analyzing it. How does the cost of that put enter into things? Okay, so yeah, we've got 25 minutes to the market opens, and consumer sentiment's at 10 a.m. So that's in 55 minutes. This just takes a moment of explanation. So when you buy an option, if you buy the one that's at the money, in addition to its intrinsic cost, which inherently represents its intrinsic value. So if you buy a 400 put and current price is 410, no, let's see. If you buy a 400 put and current price on the market is 390, then it's $10 in the money. The price of the thing is lower. You bought a put that was 400 and the price of the thing is 390. And so, oh, hey, good morning, Marcus. Ooh, Dominican Republic, guys. Ah, gorgeous. Beautiful. Hope you're getting some pineapple and some waffles and whatever breakfast they have there in DR. Yes, very nice. Cool. So just to explain this though, so okay, so Randy, I'm explaining to you intrinsic value of an option. So if you buy the 400 put whether or not the price of the underlying goes to 390 or is at 390 when you buy the 400, which would be weird, yes, but we call that in the money. Um, at that moment, it's $10 in the money. Are you following me that far, Randy? So if you buy a 400 put, but the price of the underlying is a 390, it's $10 already in the money. Okay, so that means um, per share for a 100 share pack, which is what options are, it's already $10 in value. It's like, wow, cool, right? It's already the $10 in value. That's called intrinsic value. On top of that is extrinsic value, which is like, you can kind of think of it as the time value. If the thing has time left at that moment, on top of the $10 of intrinsic value, at that moment, it has X extrinsic value, X, amount of extrinsic value, which is they call premium. Okay. Now, in an hour, maybe the price of the underlying goes to 389. And so let's say the extrinsic value, the premium on that $10 intrinsic option right there was $1 when you bought it at 390. Uh, it's got $10 of intrinsic value, and then the $1 of extra value was for nothing. It was premium, right? Now, let's say the stock moves down to 389, so it moves down $1. Now the intrinsic value is $11, and the amount of premium on top, the icing that's on the cake, the puffed up premium, because of time decay, remains similar to what it was, but it changes a little bit. It probably goes down. It gets sucked out in values. Now it's maybe 89 cents. So, 89 cents, the extrinsic value. Stop bothering me, cat. So now it's $11.89 in total value, the thing. So, okay. So that's intrinsic, extrinsic. Okay. So the intrinsic changes intrinsic inherent to the actual mathematical difference, and you get the absolute value indisputable by contract as a value for that option. That's intrinsic value. They can't take that away from you, except if the price changes on the underlying. Okay, by expiration, it's over though, and you get the final amount, right? And then, but the extrinsic value is kind of constantly changing. The amount of fluff on top, it depends on how exciting or interesting that option, that underlying is. So that's called volatility. Depends on how much time is left as time is decaying. Depends on if it's a really distant possibility or if it's a very probability. If it's a distant possibility, no one's interested, and so maybe you only have to pay $5 for something like that. Okay. So your question was, good morning, Carl. How does the cost of the put enter into things? Okay. How does the cost of the put enter into things? Okay, so it's important to remember that when you enter whatever the cost for the option, it's only actually costing the extrinsic value. Okay. At the moment you put it on. Do you follow? That's an important thing to remember. So if it's $11 for that $10 in the money option and $1 for the premium, the extrinsic value, then it's costing you $1. Okay. Now, but if you buy that for 30 days, let's say you want to slap a hedge on your portfolio for 30 days or 60 days or half a year. Um, think about this. Realize this. This is amazing. The longer you buy, the longer that premium you paid, the cost will decay. In other words, if you pay $1 for a 3-day option, I'm talking premium now, $1 on top of the intrinsic. If you pay $1 for a 3-day option, but you could pay $2 for a 1-month option, Yes, $2 is more, but it's going to be $2 divided by 20 days. And so every day it's going to go down 66 cents or whatever the fuck that is. 50 cents, $2, 50, 10 cents, whatever it is. Do you get me? But a dollar for 3 days is going to go down 33 cents per day. It's going to do it 3 times as fast. So uh, when you're getting these hedges, if you don't want your money that you're paying in excess, the insurance cost part of it, the premium part, to eat away too fast, to deteriorate too fast and be a waste, then you should buy one of these options that's liquid. Okay, it's still got to be a liquid, but at a further out strike in time. So maybe a month or 2 months or 3 months or 6 months. It technically, if you have the money, it doesn't matter. You could get a 1 year, because the cool thing about the 1 year is by paying so much more for a 1 year, additionally, you're only losing 1/365th per day, essentially, in theory, on the extra cost you just paid for that, which would be a lot. In other words, there'd be a lot more money that you're paying. Not a lot more. Let's say it's $1,000, $10 for that one I was talking about. If you bought it for a year out, it might be $1,400 total, so $400. But then you divide $400 by 365 days in a year, and each day now equals a very reasonable amount that you could be willing to lose every day, and that's your cost. And then finally, yes, that's your next part of your question. That's important. Is so what's the best to use, at the money, in the money, or out of the money? You would think at the money, but no. At the money is where the premium is the most expensive. If you go deeper in the money and get a 70 or 80 delta put, that's in the money, so it would be a higher price than the current price of the stock of the underlying. Weird, because it's upside down. In the money is not deep, like down low. In this case, it's the inverse because it's a put, so it's up high. In the money, and a put is is when you get a strike that's higher up, because the things that makes it in the money already. Okay, so when you get an in the money, the more in the money you go, that triangle, that cone of price that you have to pay from at the money, which is the peak, which is the highest, the worst you will pay is at the money. It goes down similar to out of the money. And if you get a 70 or an 80 delta, or an 85 delta, or a 90 delta, then you're paying almost next to nothing in premium. Now, that option obviously will be more in the money. In order to be 90 delta, it'd have to be a lot in the money. And so per option that you buy on that, it's going to cost a lot more because it's got intrinsic value. But that's not really the cost, because if that's truly hedged against your portfolio, then every dollar you lose if the price goes against you on all that money you spent in intrinsic value to get that in the money option, if it goes against you, if price goes up on the market, all the money you would be losing and it's chipping away on there, if you've properly hedged, you'll be making back on your other positions that are market correlated, because that's how hedging works. So it's kind of neither here nor there. No, cat. It's neither here nor there how much you pay for it. So if you have the money, you should get the one that costs the least over time, which is the one that's more in the money that costs more. Because the cost isn't really the intrinsic value, it's the extrinsic value, you see, especially when you're hedging. So did you understand that? I think that kind of answers everything in what you were saying. I believe I educated you on that, right? Hold on, I got to put this cat outside of the room. It's bothering me at every juncture. Kitty, kitty, say hi. Ugh, I see. So by 70, 80 delta in the money as a normal hedge times the number of deltas needed. Yeah, because if it's 70 or 80 delta, the cool thing about when you buy QQQ puts and you've checked the box beta weighting to QQQ for all of your positions, the the nice convenience of that additional, it's like a coincidental nice convenience, is that the delta on the option chain for the option that you get is going to be the exact delta. You don't have to do like any conversion or anything like, okay, because if you wanted to get um, some other asset that wasn't QQQ, you'd now have to figure out what is the correlation of that asset per delta to QQQ. But luckily, it's the same thing. So QQQ, when you go to the option chain, the deltas that will be listed will equal exactly the deltas you want. So, if you got a 12 deltas, which would be terrible, that'd be a way out of the money option and it will dwindle way too fast and not provide proper protection. But if you get a 70 or 80 or a 90 delta, uh, then it's going to give you positive 70, positive 80, or positive 90 deltas in your portfolio. It's like a weighting. It's like it just drops into your portfolio and floop. And then now the bottom line summary of all your deltas will be adjust because a put deltas are negative. So if you have, like for instance, I have 138 positive deltas on my positive positions. I have 138 positive deltas. So for every dollar the market moves, I gain or lose $138 in my positions. Okay. I have 138. I have two QQQ puts that are in the money. Well, they're not super in the money. They're 63 deltas each. And the more in the money they go, the delta gets a little bit, it kind of expands and it gets even more helpful. And so in total, I have 120 deltas negative. I have 120 negative deltas because I bought puts, two puts on the QQQ. But I have 138 positive deltas. Therefore, between those two, my portfolio is positive 18 deltas. And of course, that shifts throughout every day, and you just kind of got to keep an eye on it, because the deltas on 20 positions or 30 or 40 or 50 positions, they shift around because they moved in good and negative ways to the market, correlated, non-correlated, they move around. Okay, but check this out. So I'm positive 18 deltas, right? But I have 19 negative deltas in bearish positions. So I'm fucking perfectly hedged. You see? Because that balanced out that, so I've hedged my positive deltas with QQQs. There was what didn't quite make it. So I stuffed some bearish positions in my portfolio. They happen to be the exact size that makes up for the difference, and now I'm perfectly hedged. Now, the downside to hedging is that, let's say we kick off a huge bull run here. We're not going to get delta return on those credit spreads or anything that's moving in correlation, in lockstep correlation with the market. But if something's moving in excess of the market in correlation, like more, we will get a return on that. But the market amount of hedge we have is going to cancel whatever moves are perfectly market correlated in our positions. So those get subtracted from the gains and they cancel each other out. So, but we will get excess. And then there'll be others that didn't move as much as the market. And then so now we won't get excess and they'll cancel each other out. And that's why probably in the long run, with 50 positions on, you will see it just perfectly hedge and you probably will not make money on the delta side of things, but your thetas will be working for you. Okay. And I'm fine with that. Like what that will look like on an equity curve over the year on your portfolio and your profit loss equity curve for the whole year is that during this time when war was fucking, on the table, your gains are going to be flatter But the nice thing is your losses are going to be non-existent. They're going to be loss side is going to be smoothed out, but like your gains are just going to be not as testosterone driven. They're going to be theta only, not assisted by delta moves. It's going to be very similar to if you had iron condors on everything, or it's going to be very, and it was sideways, or it's going to be very similar to if all the stocks that you got into just went conveniently sideways and you just had a daily drip of theta going on. What distance out do you normally look for? Well, mine, for instance, on the QQQs right now are the June 21. Uh, but I'm losing, it says under theta, if you put a theta column on your position statement, it'll say how much theta would be lost per day. That's a daily figure. On mine, it's $16 per day. It's kind of a lot. Like I'm not too happy about that. But I could have chose out more. It's completely up to you, Randy. Like, I mean, you can ask me that, but don't copy me. Like, because you might be able to do better if you use your own brain. Your situation might be like, well, I'm only I'm using 25% of all my money for positions. I got 75% of my money left over. I might as well decay the least possible. I'll go deepest in the money, 95 delta, and I'll go way out like 6 months so that even the 5% delta, whatever, that I am paying for premium will chip away over the course of 180 days. It'll be divided by 180. And then your theta column, instead of saying negative $16 like mine every day, we'll say like 0.20. You'll be losing 20 cents a day. So you can it takes money to make money, right? Like in order for you to not lose as much money per day, you would have to pay more money. It's sort of like when you get insurance on your car. Uh, and do you hedge when things are in an overall uptrend? And no, that's the thing but it's not just about the uptrend because things are in an uptrend. I would not be hedged right now. This is a beautiful thing that's going on in the market. It's bounced and found support above the underwater line. We're coming up to new all-time highs. We're really close. I'm not concerned when I have long PCS type positions because they can pull back and still pay slash break even. So the only reason I'm hedged has nothing to do with the market really, with the market uh, being bearish or something. And if the market was in an uptrend, I would unhedge. But the market is in kind of an uptrend right now. But I'm hedged. Why? Because any day could be obliterated by some, everything's on the precipice right now. There's quite a bit on the precipice. Everybody's worried about so many things, right? That can change, in warmer, better times. We're having like a winter. We're experiencing a winter on the market. Just looking for general guidance, making sure my thought process here is correct. Yeah, I believe your thought process is probably correct. I entered a PCS on Qs and the results are not what I expected. Yeah, you weren't supposed to enter a PCS. How many deltas does the PCS have? Very little. You'd have to get like 20 contracts, to get the proper. Yeah. I started to think just now this morning, it's the first time I realized that you probably got a PCS on the Qs. Last night, even looking at it, I was like, oh, he's got that nice hedge in there. Yeah, I know. You got so good at getting PCSs that when you were supposed to get just a flat out put like everybody else, you got a PCS and you actually made a mistake. You made a mistake because you're too seasoned. All right. Well, anyway, we got consumer sentiment coming at 10 a.m. Does anybody else know of any stocks that are up this morning on earnings? Let me know. I think somebody said something about Micron. I'll check that in a second. Maybe that was yesterday's news. NTRA. Okay. Micron. No, it's not up very much. Um, NVAX, Novavax, SG. Did they report earnings? They're up quite a bit. Yeah, that was earnings. $24 is now $30. Sweet green. This is a gorgeous type of chart on the daily. Really nice. And now blue sky breakout. It was being bought up prior to that. Bought up and fell. So kind of neutral when it opens, probably. Gap theory analysis there, probably neutral when it opens on sweet green and could go in a positive direction. What do they do? Sweet Green steak launch expected to bring meat eaters in. What is Sweet Green? I don't even know what they do. Owns and operates a chain of salad restaurants. Okay, man, they got to be doing really well. That's a great idea. You know, the overhead on salad, the profit on salad must be really good. I would imagine. What are the margins here? Actually, they're losing money. But that could be because they're expanding, that could be cost of building out, physical locate. I don't know how they run their place. But anyway, Sweet Green might be a potential buy this morning. What else here? Earnings. That's the earnings for next week. Baba, Walmart, Nucor, Home Depot, Applied Materials, Baidu, NXT, Cisco, JD. These are all T2, Monday, OCGN, Wolf, TME, MNSO, Sony. These are all next week's earnings coming up. Other things that are up this morning, that was 11 billion. ADMA, 2016 PCS is showing negative 108% this AM on S. You have a PCS on SG through earnings? That's not a good idea. Was that a lotto or something? Did I alert a lotto? No, I didn't alert a lotto on that. Don't ever hold a PCS. Okay, all right, that was a mistake. All right. Yeah, that happens. You got to be diligent about watching out. You never want to hold a PCS through any catalysts. Most of the time that's ERs, but sometimes it's something like a conference, like Tesla might have a conference or Apple might have a, what do they call that? I don't know if they still do it, but they used to have like Mac World, I think it was called or something, an expo, Apple Expo, stuff like that. You don't really want to hold through those. LiDAR, down. Oh yeah, how would it sound do? Downhound, down looking good. Now that their ER is passed on some of these companies, we're interested in them, but not so much on sound. It's such a low price. Liquidity is going to be low. Um, a lot of unnatural movement. VSCO, that's Victoria's Secret, right? Let's see. VSCO. Oh God, they're just doing so terrible. $55 billion company CRH is only up 4%. Well, that looks good. How if that 4%, that looks like a good 4%. That is a beautiful chart. What's the liquidity like on CRH? How many minutes we got here? Shit, we got 20 seconds. All right, CRH. No, no, no. Option, no volatility. Applied volatility. Oh God, it's way too low. All right. Well, that's what we would expect. If it's a company you haven't heard of, the liquidity is too low, probably. All right, let's watch QQQ at the open here. But it really doesn't matter because the report comes out at 10. Wow, I'm already getting some sales inspired by Randy. Actually, Randy has been very diligent about getting his 50% take profits in, and I just got two orders right at the open filled. Three now. Are you hearing that? Are you hearing those blings? And that was First Solar, TSM, and Netflix. Great. Just instantly locking those in. And then the other thing I was going to check was, do I have more contracts in those? Because the way I like to do it, I'm not the same. It's probably not the same the way that Randy does it. Randy probably puts his full order in, but the way I like to do it is I only like to to sell one contract, close one contract of all the contracts I have in the position. They go bling. I go, oh, what triggered? Maybe I should sell more of that. And then I go take a look how it's looking on the day. So it was TSM. And yeah, that's highly elevated. Wow, on some news, probably. And how many more contracts do I got on that? One. And so, okay, I'll just let that gestate throughout the day. And then First Solar, that's doing great. It's up overnight as well. It did a filing, and somehow that's good news. First Solar, where's that on my list? There it is. Okay, it's at 45% uh, max profit, but already sold it. Okay, something else just happened. Kava also. Look at that, Kava. All these stocks are flying, making new highs, and the market's just, not in particularly that crazy. But when you've got these things making those nice gains, it's really great. Now, Kava, yeah, it's at 85%, and I got one contract left. I'll probably sell that in a moment here, maybe while we're still talking. But the other one that also hit was Netflix. Nice. Netflix, that's 61%, and I have two contracts left on that. So overall, very good. The market's opening elevated over yesterday, over yesterday's close. It's already opening up. And so that's good. And then our list here from the open is about 60% green. Oh, that's dropped back already to about 55%. So pretty neutral opening. But some of the top names flying are ARM. So it had earnings, went down a little bit. This is a breakout entry on ARM. Do I have any ARM yet already? No, this is an entry on ARM if the options provide. Let's take a look. ARM 22 delta is 97.5, which would be right about there. That's underneath this pivot. It's rather close. However, yeah, let's see how it pays. 22 delta, $62 out of 188 capital requirement, 33% ROC. It's a nice little trigger spot. I'm going to go for it, but I might need to get too many contracts, so I might spread that wider. I might go for a wider spread to get the fees lower. All right, so I'll probably I'll check out the pricing on the 97.5, 92.5. Yeah, that's $1.12 for, well, so multiply the contracts out. 672, 2,328, and that equals, come on, computer. Well, I gotta have a calculator I'm gonna have to have a physical calculator just sitting on my desk from now on. 672 divided by 2328, 29% return on the capital. That'd be great. That's at $1.12. It's already at $1.19 now. That's great. Now I can reduce the number of contracts I get down. To remember what I was telling you last night, my allocations should be about 1,400. 1524, perfect. And I'm getting $1.19 credit. Let's send that off on ARM. It didn't fill. Come on. You can do it. Because now it's only giving me $1.16. It's because it's doing well. It's already gaining. Oh wait, the mid is now 122. All right. Change my order to 122. It's possible that there's just not enough buyers and sellers or market makers to get the right price. But wow, the price is getting better. And that might be because it's failing out as also. Right. So I'm trying to get ARM It would be this, the June 21, 97.5 for $1. That's rather flat. I don't love the way that looks. 96.5 would be the break even. Yeah, not in love with that trade, but I'll probably get the fill. Interesting. The angle of decline on the stock whenever it declines almost perfectly matches the angle of the put spread break even. Just like we were talking about last night. Okay. Other stock that's doing well this morning is Cell H. I think we're already in that. Cell H, where are you? Yeah, I'm already in that. So, okay, that's doing well. Do I want this arm? Yeah, I kind of do, but boy, that it's not the greatest um, strike level that's qualifying for the deltas. Let me double check. Maybe the deltas have shifted in a better favor. Delta, 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 23 or 19. Yeah, I could get the 95. Okay, I got to cancel really quickly because I don't want to get filled on that. I could get the 95, which is now 19 delta, and that's better. Arm 95 would be down here. That's a better level. Okay, 95 delta, sell, 92.5 delta, buy. I probably want to get the 90, but 92.5 delta, buy. Um, and so that's offering 54 out of 196. 27.5% return. We're definitely sporting and rocking great ROC on this arm. If I go 95.90, what do we got? $97. Yes, that's 25% ROC. That's good. Okay. I'm going to ramp this up and get a fill. $1,200. That'd be perfect. See if I can get edge it out a little bit. Sending 95.90. Can I get a fill? I bet you those are more liquid strikes. Dang it. There we go. And I got filled at 97. Damn, I was about to move my order up to 98 because it said it could get 98. That's okay. There we go. I'm filled. All right. Arm is in. The arm option is in. And that was the 95.90. So now watch my break even change now that I picked a different strike. We got to change that to the 95.90. The break even for $1 credit was 97 cents, is roughly 94. So now instead of 96.50 as my second point here to draw this line, we go to 94. And look how much better that is. Yeah, it's a bit better, man. Ooh, right there. I'm putting myself under less pressure by doing that. All right. So that's arm. Cell H is doing good. Let me just double check that's not a trigger for you guys. Hubs. Well, I mean, not really. The cheat entries on Cell H were back on May 3rd, and then there was one yesterday. And I got in yesterday, and things are doing great already. Cell H is now up 51%. I have 55, 6%. I have 4 contracts left. Why didn't it sell? Do I not have an order on that? Let's see. I should already have an order inspired by Randy. He's so diligent about that. Cell H does not have an order set. That's interesting. Maybe I accidentally sent it today instead of GTC. But anyway, it's at 55% max profit. So I'm definitely selling. I'll put that 1 penny less. See if we can get that. Close one of the 4 contracts down. There was insta fill. That tells me I can get a better price than that by a lot. Try another contract, but this time let's be more aggressive. Let's try 35. No fill. Good. Let's just let that sit there for an hour or two. All right. That's called working your position. All right. Others, arm, cell H, Kava. Yeah, Kava's flying. Look at that. That is flying. In addition to selling, it's possible, like I mentioned last night, to convert to an iron condor. See, now, just for, oh, but see, we got earnings coming up on that one, so I don't really want to do that. Randy says that he's now up 792% on your 2019 PCS on SG. Yeah, no, you can't be. So that's a bid ask anomaly. You can't be up more than 100%. So that it shows that's some kind of bid ask anomaly and inefficiency, whatever you want to call it. And you need to probably put an order in to sell at a penny. I mean, to close it, to buy it, to close for a penny. No, it's not something that's to be fixed. It's just how things have, how people have made their bid and asks and offers and stuff on certain things. When you got compared to when you got it. It means one of the strikes that you chose is highly illiquid. But anyway, just let it gestate, but put an order in to close that out for a penny or the lowest incremented price it allows. Sometimes it's 5. Anyway, what I wanted to check here was on Kava. What is the angle of a call credit spread on the other side to go iron condor, which would trap gains where they are? We would secure gains. It would pin down the gains on the PCS and then just let you ride it out without price change. So the CCS 20 delta is the 95 100. Yeah, and it's not very liquid and it's 65 cents. So 95.65 we talking about, and that is right there and would look like this. So my question was, is the angle of ascent on Kava better or worse than that? Because that's what we can expect. And now we can just move this line up to current price. And we can see that Kava moves at a rate, which is the white line there, underneath what we could pay to open a call credit spread on it. So that's outstanding. That's like some of the advanced stuff we were talking about in class last night. Mark, Carl, Bob, you weren't there. Mikey or Michael, you weren't there. Where were you? Uh, but you know, at this very extended point on Kava, it could be a great time to get a call credit spread on it. The only part of the only problem of that is it's got ER coming up in 18 days. So if it wasn't though, and it was like 24 days or 30 days or just lots of runway before ER, I would totally do it. I would totally do it. I would convert Kava into Iron Condor. Because the way this market is, number one, things are not just going to go whoa to the moon right now. The market's a little bit under pressure, although it's having a very good day this morning, it looks like. Anyway, so I'm going to opt and err on the side of closing out my put credit spread instead. It's at 87% max profit right now. So it's doing great. All right, looking at, okay, so there's ARM. I got that. And also remember, you guys who are really trying to learn this, um, when you put on a new position, you now added deltas. You got to, at the end of the day or somewhere in the day, you got to reassess how you're hedged if you want to be hedged. Now that one added, um, ARM added 17 deltas, 17 positive deltas. So I have to, think about, how that affects things. And if I want to, hedge anything. One way you can hedge is selling something, selling another positive delta, selling off 17 deltas and some other stuff. You can start to get smart about this, right? To reduce, you don't have to get a put if you already have puts, But to get yourself back down to kind of like zero neutral hedged, you could sell something. Another thing is you could convert something else into an iron condor. That will reduce its positive deltas. Another way is you could open up a bearish position on something. So there's like multiple ways you can create some negative deltas or reduce your positive deltas to make up for that. And I got all day to figure that out. So I'll be just fine. By the end of the day, though, I hope to be absolutely perfectly hedged. And right now, I'm under no stress or worries about it. All right. Also, top of the list. So CellH, Kava, SMCI. We're also in SMCI, and it looks like it's doing well this morning. SMCI, where are you? Nope, there you are. Okay. All right. We're back to break even on SMCI because well, I've been in it for a while, it looks like, and it's put me through a little bit of the hell and the ringer, and I actually accidentally held over ER. That was, a mistake. But it's coming back up and doing good now. I wonder if that's a new position since ER though. Let me double check. And it's up now. It's actually up 7%. View trade. This is on 5.8. Actually, yeah. So I re-entered SMCI yesterday. Smart guy. All right. Sell H Hubs, Kava, SMCI, SAIA. Nah. ARM, NVIDIA. NVIDIA looks great. And a couple days ago, I said it's a good idea to get a put credit spread on that or a bullish position. In fact, nice trigger point over to cheat entry over a pullback, top line resistance. So it's doing well, and we're heading into earnings in like 2 weeks or a week and a half, whatever. And where are we at on that? 26% max profit right now. So it's doing well, and perhaps will continue to do well. The market, let's take a look back at the market. And in 12 minutes, we're going to have consumer sentiment report coming out. We're going to find out if all of this wonderful bullishness is going to get wiped out or if it's going to become supported or even run on some positive data. Who knows? In the meantime, seems like people are buying growth stocks. It's interesting. I'm in it. I'm in a bunch of them. Spotify, I'm already in it. Also having a good day. It's doing well. I'm at 41% max P on that. I have a DJT order in. No? Oh, I need to get that order in. So all day it can be attempting to fill. I have one contract left. I just want to get rid of it for $1. Close it early. All right, I'll let that sit there all day. How is DJT looking? Oh, wow. Very nice. I did mention that yesterday was an entry point for DJT. It was a signal, this kind of move, very nice. So I did also, I'm simultaneously closing this old one at 99% profit. And I've opened a new one yesterday, which is already now at 7% max profit, which is technically probably accelerated gains, but I'm going to let it gestate a little bit longer. Tossed Monday because I don't want to get myself relocating capital too frenetically, too frequently. Monday, okay, they've got earnings coming up on that, so we can't really do anything about that in GPS similar situation. These are stocks that I'd be interested in being in, though. NRG, we want to be in, but it hasn't provided good options quality. But yeah, this is outstanding. Anybody get that on shares? I mean, I've been recommending shares entries for weeks now, and it's just doing great. IoT. We're all ideally interested in something that has earnings behind it now and is great looking. Oops, and we want to be in it. What else we got here? Jen is up a lot this morning on the S&P 500 MTD. That one didn't qualify, by the way, Jen. MTD. Yeah, that's just like too much. Wow. What is this? Medler Toledo. Never heard of that company. Health. $1,500 a share. NVAX showing up on multiple lists. Boy, is that a huge pop. It's up 127% this morning. That's biotech, guys. Sound. This was the one we were talking about. I felt was going to be, I believe this was the one I felt was going to have a neutral reaction. Ben says, if only I had a dollar for every time Evan admitted he screwed up, but then realized he technically made the correct decision after further analysis. Yeah, no kidding. He follows his rules. Yeah, but I do override them, but usually only when there's egregious benefit. I never override a rule in a negligible or difficult to interpret spot. You know what I mean? Like, unless I clearly can see something that, from experience. But it's usually very obvious, like, yes, we should override the rule. And then that's why you override it. Para, Mobile Eye. Just blasting through some names to see if there's any more opportunities to A, add to my portfolio, and B, add to yours. Some of the stuff that I'm holding, let's check what's up and down PNL on the day. What's up the most is SMCI today. Oh, FCX finally taken off. Just look at that, just that little move. Like I entered back here, went underwater, came back up, went down. Boom. Yesterday, FCX had a nice move there, but it moved back to essentially break even. But today it just went boop, just right to there, just boop, right up there. And yet I'm up 24% to max profit, like a quarter. That's really good. That's like 7% return on capital for a move that's only a 1.6% on the day. So I got a 7% return in a day from the PCS when the stock itself only moved up 1.7%. And by the way, it's only back at entry. So if that was a shares trade, you'd only be break even, let alone gone through hell of a pullback up to that point. The PCS didn't experience any of that. Anyway, FCX looking great. I bet we even break to new highs today, if depending on how this report comes out at 10 o'clock. And we do have 6 minutes until that report comes out. Let's see what happens. TSM looking good. Probably I should take the fixings while the fixings are good. But let's see here. I got one contract on TSM. Is that right? Yeah. So I'm going to keep everything that I have that's over 50% max profit, which are technically all rule based. You should take the profits points. And then if the consumer sentiment report comes back in a way that demolishes everything, I'll quickly close out those gains so I can relocate capital into other things. Otherwise, I'll just let them play out to the end of the day or maybe even hold them over the weekend. We'll see. I'm hedged. I'm hedged pretty much perfectly right now. What else is doing good here? Let's see. Or bad. Let's see. Okay, and Tesla. DraftKings. See how that works? Remember, we were talking about iron condors last night, and that I got in on this day as an iron condor because well, it's kind of hard for you to see, but it had a big red day on ER release. Oh, I just realized this is still from last night, a little bit too washed. There we go. On ER release right here had a gap up open and then a bleed out day, right? And then the next day went back up half. So I was thinking, yeah, this might be a good point to open an iron condor since it's sort of indecisive and now definitely under pressure on the top side with several pivot points above to have to break through. So a lot of overhead pressure. And then underneath we have pressure to buy, demand, right? So I felt like a good spot to get an iron condor. But now here's the cool thing we talked about last night. So I got in right here and then price went up, then it went down, then it went up, and now it's down. And all that zigzagging, it just shakes out theta. It's just like, it's going back and forth, but where's it going? Sideways. That's all. All those back and forth moves are just great for an iron condor. And the more it does that, the less chance, the less likelihood that any strong move in one direction um, would hurt you very much, and that you'll be able to, using the system, wait it out if that were to happen for it to zag back inside of the iron condor's mouth. Maybe we should. Ooh, maybe we should have like a shirt. This is like iron condor, and it has this fucking iron condor with this mouth. I should ask AI to design a really cool T-shirt like that. That'd be fucking cool. Something just sold. What was that? Something just closed in my orders. I gotta check it. Sell H, the second option at the aggressive price sold, and it is now up 61% to max profit today. And I got two contracts left, and I'm going to put another aggressive order to sell out there. But I'm going to make this one, it says 33. I'm going to make this one 28. And we'll let that sit there for a few hours. That one only needed to sit there for a few minutes. All right, 3 minutes until consumer sentiment comes out. And again, if you have any tickers for me to take a look at, I'm happy to look at it. I can't remember everything. I can't know everything we need to look at every day because sometimes it's situationally different, and I only have my setup dialed in to mostly what we do. So there might be a right hook out there though that I do have some insight on for you. And if you're looking at it, please don't stay in the dark. Let me check it out too. Let's take a look at it. So opportunity is opportunity, and I might be able to say something about it. Vulcan Catalyst Day VLCN. No, penny stockish. Those Catalyst days are more for penny stock trading. ANET's having a good day. Okay, well, yeah, that's what. Wow, talk about fast right side reclaim. I mean that's an entry on ANET. Can we get a credit spread on ANET? That looks outstanding. We've got 1 minute 30 seconds till consumer sentiment comes out. 25 with a 290. Damn, that's way too close. But then it skips down to 16 delta. If I go further out, can I get a 20 delta there? I could get the 280. Oh, yeah, and they're pretty liquid. The 280, but this would be further out. This would be the July 19, 280, 70 days to expiration. 25% ROC, and that looks like, let's see, July 19. I haven't even considered these options yet. Okay, July 19, and it's the 280 for $2. So the break even is 278, and it would look like this. Yeah, I don't know. That doesn't look like well, I mean, this is a hell of a chart, but look at this drop here. This earnings report has been good and really catalyzed a new bullish move. All right, I'm gonna go for it. We'll get two of those. Let's fill it up. Fill it up. Fill me up. Let's see if I can get 5 cents more per contract. We'll just open that up real quick. If it doesn't get filled, then within about 20 seconds, I'll change that. Okay, let's go take a look at the Q's reaction to the consumer sentiment report. Here it comes in like a second. Boom. Consumer sentiment report is out. Should be. Sometimes these things get delayed for technical reasons, but no, I believe it's out, and it's 67.4 versus a predicted 78. That's actually not good. Okay, yeah, the market is pulling back on this news. This is a pretty big drop in expectation, and this is the lowest report that we've had since November of last year. So consumer confidence is down. In some sense, though, that's good. That means people are going to save and stop spending and causing inflation. I, I don't know. I think there's also a silver lining to that. We want that. The Fed wants to beat down uh, people and stop them from spending. So, in some sense, that's good. Okay, I didn't get a fill on that other thing. Let's see if I can get a fill. What was it again? ANET. Okay, let's try the dollar. Let's try the 5 cent last. There we go. Got that fill. All right. I have an open position on ANET now. Long. The one that I drew. There. Put it in the books. Book credit spread. That's interesting too, because I took a much longer outlook. It was 70 days to expiration, but that certainly gives me a lot of time. And Kava's now at 90% with 42 days left to expiration, and I'm at 92%. I'm gonna see if I can get. I might just let it fly for the day. Let's see, how is it reacting to the news, Kava, and how did it react to the news, Kava? Ah, it did not have a very bad reaction to the news, so I'm gonna let it gestate a little longer on the day. Like last year, what, Ben? I don't even remember what we're talking about now. Hmm. Yes, beat down by Fed. Yeah. This is what the Fed's looking for. It's not good for growth. The demand, the numbers are not going to be demand, the amount of money that's out there for retail and consumer facing companies, but B2B is probably going to be okay, but they'll still be affected by the fact that consumer confidence is down. But that's what the Fed wants, and that will cause deflation. That will cause some deflationary effect, consumer confidence coming down. Michigan preliminary May consumer sentiment falls to 67.4. Estimated was 76.2. Somebody says very bullish. What the fuck are they talking about? I mean, I guess, on the fact that that's what the Fed's looking for, but that's not fucking bullish. Higher on inflation expectations. Michigan inflation expectations, actual 3.5%. Previously was 3.2%. So also in that report is consumers' expectations for inflation, and they're expecting prices to go up, inflation to go up. They're expecting that. So what? They don't know jack shit. Maybe it's not going to, but by the way, that's what they're expecting. And so as a result, their confidence in spending money right now is lower, which ironically is going to cause deflation and make them wrong. Fucking morons. Public, what can you do? Just remember that George Carlin said, remember that, realize that although the average is 100 IQ, half of the people are dumber than that. Because that's the way that fucking thing works. If the average IQ is 100, that means half the people are dumber than that. Thank you, George Carlin. I mean, that's one hell of a realization. Yes. All right. Looks like we're finding some support here, and I'm not going to watch this, zigzag all morning here. It was not a, you know, huge move, but it could turn into that. So watch out. It could be an avalanche. Who knows? But I'm hedged, so I'm all good. And let's stay on top of everything in the group. Looks like we're about only 30% bullish off of the open now on our growth stock picks. So this did affect how things are looking from their open. Things kind of under pressure, but we already opened elevated, so it's all inverse psychology and stuff. It's tricky. We're making a higher high. Even if we have a red day, we'll have a higher high and a higher low, probably, unless we get a engulfing bar. All right, guys, have a great weekend if I don't see you. And thanks very much for tuning in this morning. Have a good one. See you back in the group, everybody. Stay safe out there. Trade smarter.